Welcome to Blockstart Ventures first in a series of investment webinars. In these, we explore strategies, challenges, and perspectives for investing during and even in a post-COVID world. In today's webinar, we discuss specific option strategies for creating safer investments. Blockstart Ventures general partner and investment manager Raman Bindlish shares personal, time-tested option strategies for acquiring stock at below market rates, in some cases, even free. For more information on this and future webinars and events, please visit our fund's website at blockstartventures.com. Now here's Raman.
Wanted to talk about is, of course, like as many of you know, we have our Blockstart Ventures fund. So I'm just using the template. So today, I think we're not going to cover what we do. So whatever we are talking about today, first of all, of course, Nico is my partner in the Blockstart Ventures, and he happens to be a lawyer. So he always tells me to always put in any content which is being presented to be very clear on our legal disclaimers. So let me get through those. So none of this information has to be considered any investment advice or any solicitation. So just keep that in mind. All of you are anyway friends in some form or other, like, in some groups we are, so you know me. So I'm not worried about that either. So today, I think as a Blockstart Ventures, we did some market surveys. I would share some of that. I hope that would be useful. What we are seeing from people in terms of the market direction, what are the asset classes people are investing in. Then I think from options perspective, we'll talk about some of my strategy, which I have used to buy stocks which I am interested in below market price. For example, like, just reducing risk on when you are looking to buy certain things. You're not sure whether that's the right price. So options can help you reduce the price, and that's what traditionally, like over years, for me, that has been the most successful strategy, where I kept on reducing my buy price of a stock. And the other thing which I'm a big fan of using options is for generating high yield on your cash. Like, the basic intention is, many times we as investors, we keep thinking about, okay, I'm waiting for the right time to invest, and we hold a cash position in our portfolios. And what I always look at is, can we use options to generate yield? Like, sometimes they are very, very safe, 100% triple digit yields, 100%, 200% yields available in the market, which we just let go, and we are not using our cash. So I'll just share some of those ideas. Then, of course, managing the positions. Once you enter into options, I think the biggest thing about options is how do you, if the trade goes opposite to you, of course, you're taking higher risk sometimes. So how do you limit losses? How do you maximize your return? So that is some of the other things which I will just share some of these ideas. So let's start with the market survey. I think this is interesting because it's very different times these days. Like, I think it's not a normal market conditions. We all have seen what's going on because of COVID. A lot of like, it's very unintuitive what is happening. Like, we were expecting market to crash, and it happened in March, and then we recovered really beautifully in stock market, and now we are like at all-time highs, which is something which scares some people. And so we were just trying to figure out where everybody is. And this is just first question we asked, that what is your investment style? So as you can see, we are, being a venture fund, most of our audience, and I think the people, like most of you, are part of some investment group of mine. So what we are seeing here is that most of the people are active and self-managing management style investors. So this is kind of a skewed audience of our survey. This shows that this is not perhaps representing average investor. This is like sophisticated investors, because we deal with those, and also because all of you who are very actively involved in your investment decisions. So that's what is happening here. So this is just to set the expectation of whom we ask this question. So this may not be like a average across the population, but more or less those people who are actively managing their investments and choosing their every investment themselves. Or in other words, as we say, sophisticated investors. So what we are seeing there is we ask them, like, what is the asset classes they are investing in at this moment. And as you can see, 100% of them are in stocks, which is not a surprise, I think, because of, again, as I said, the audience. Most of us were part of some of stock investment group or something, and it's obvious, I think, over the years, that stocks are the most popular. But interestingly, we saw that 50% in real estate, again, a very popular asset class, gold, silver, which is interesting again, more than 50%. Crypto, again, this is a kind of very controversial for some and very exciting. It's a very, very divisive asset class. Either you hate it or you love it. But it's interesting to see that 33% who are the people who are self-managing, 33% of them are investing into some form of cryptocurrencies. And of course, then private equity investments, which is usually reserved for as accredited investors and so on. So there are like 9% of those. Going forward, I think this is the interesting question, which I think everybody is trying to understand. Where are we heading? And as you can see here, almost 50% are worried that market may go down in 2021. And there is still a significant bunch who thinks we have a lot more upside. And I think as usual, quite a few are unsure about the direction. So this is just to set the stage of what are the strategies we want to talk about and so on. And always as a trader or as an investor, you start with a direction on the market. Like you don't buy stock thinking I don't know where the stock is heading. You usually buy a stock when you think that it's going to go up, and you sell a stock when you think it is going to go down or it is done enough. So these things are important when you're making your strategies. Now, having said that, again, just going back, we asked further about the Bitcoin because as Blockstart Ventures, we are very heavily involved in Web3 and blockchain technologies. So we do want to understand where the market is. And it's interesting to see that Bitcoin adoption is growing, like as compared to what it was a couple of years ago. We are seeing significant people talking about Bitcoin being a significant part of their investment and as an asset allocation strategy, and some of them just starting out. But there is still a big chunk of people who think that it's not for them yet. So that's an interesting data point. But what we have seen in the last couple of years is that there are a lot more people who are jumping into it now, looking at these percentages. So now what to expect? I think we will talk about pros and cons of using options, how to improve your ROI. The talk is like, my goal is not to talk about anything about, giving you ideas which usually research firms give, or those they claim that, okay, they can give you stock tips or what stock to buy or sell, or how to make money with no risk. Options are risky. So definitely don't assume that they will give you risk-free returns. Okay. Okay, I'll share the desktop. I hope this works now. Option chain, view full chain. So I hope you guys can see everything now, hopefully.
Yes, now I've got it.
All right, so this is basically option chain. What this means is, again, as I said, I'm not going to cover the basics. So there are options which have different expiry dates, December, January, February, and so on. So I'm looking at 1 year down the line, December 17th, 2021, where you have 372 days to expiration. What I was trying to highlight is now what you are trying to do here is, today the price is $29 for Asana. And personally, that is my view. Again, this is that Asana was $21 IPO. I could not buy it because as you all know, that it's not easy to buy IPOs unless you have a link with brokerages and so on, and unless you're buying huge amounts. So when it listed, it is close to 30 now. But how do you purchase it for a 1 year time horizon at a lower price? So if you see, because usually stock is very volatile after IPO, you will see the option premiums are huge because the real price discovery has not happened yet. So there is still an opportunity for you to sell puts for $11. So if you choose this, what you're doing, let's see. When you click on it, it gives you an option to enter. You can bid on this Asana for $11, let's say. Of course, the market is closed right now. If it was open, you would be able to purchase it because almost like a market order. What this means is your break-even price. I don't know if it shows it. Let me go further. So this is how it works. Your break-even price for Asana would be 30 minus 11. That is $19. Now, if it ever comes down below 19, that's when you start making losses on this. On the other hand, what you're paying right now is also like the margin only. You're not paying the full price for this stock. So this is one way where you're saying that for a $30 stock today, you're able to collect $11 premium. If it goes up, what is the downside? The downside is even though you're getting a $19 break even for a $29 stock, but the downside is if it goes to $100, your maximum profit is limited to $11 per stock. So is that clear? So basically, this is why I think I use this option. Again, I'm trying to use the free tools because I'm sure there are people who can do better on this with Think or Swim or something. So let's say that today's current stock price is 29. You are selling one order at 30 strike price, 372 days to expiry, and the premium you're getting is $11. So this is your risk profile. As the price goes down, wait a second, this is sell put, so that's why it's looking long. Yeah, so this is your risk profile. If the stock in 1 year from now is above $30, you always make $11 per stock on this investment. On the other hand, if the stock price keeps going down, let's say the minimum we've set at 10, your break even is at $19. So this is your risk profile. So what's the benefit? You're buying, when you buy stock directly, your risk profile is simple. Let's go back. The stock price is $29. And at $29, at every dollar it goes up, you are losing that $1. And your break-even point is $29 because you bought the stock at 29. But what we have done with using options is you have moved to a risk profile, which is giving you a break-even point of $19. So I hope everybody is clear on this very basic principle of selling puts to buy stock at a lower price. So I will stop here and ask, because if this is not clear, then I think the next discussion we will have is going to be difficult to follow. Okay, great. So I'm assuming no questions.
Sorry, Raman. Sorry, I had a question. So this number of 11, right? This is, how do you arrive at that number?
This is given by the market. This is the current market price for this.
Oh, option. I see. Okay. And so
if you go, okay.
Basically the idea is, okay.
If this is based, so what is the option? Option is telling you the longer you wait for expiry, the higher chances the price will be different from what it is today. So usually the premium of an option grows as you go farther and farther away. If you see only December 18th, 2020 of auction, the same $30 put is only $2.
Ah, I see. Yeah, okay.
So again, I'm going to talk about this because this is very useful to understand. This is called calendar spreads. Basically what you can do is you can purchase one option, you can sell another. So this gets very complicated from there on if you are not familiar with options. But what I'm trying to highlight is a very simple rule. Just to drive home the point that today the stock is at 29 and people are not sure what is the real price 1 year from now. That is why you have an opportunity to buy this stock or at $19, even though the stock price is 29.
Yeah, so the higher the uncertainty is, for 1 year, the better your chances are of making on that stock.
And this is why you will see this premium. There is no percentages. You don't know. Every $30 stock will not give you this opportunity to buy at 11 because the volatility of each stock is different and this premium which market gives you is different. So this is why you need to look at the live option chain. So this is option chain which gives you the prices of options. And I have been very successful in buying. So let me tell you, this is exactly the strategy I used for Facebook, maybe in 2015, if I remember correctly. So what happened with Facebook is, let me open this. So Facebook was listed around, I think, same, 29.30. And I was selling $30 puts and it was very volatile. It was very volatile stock. And I was using only 30 days expiries, monthly options, and with a $5 premium. So with $30 stock price of Facebook, I collected $5 premium. And what happened there is that actually the stock price went down to 20. So what happened is my break even was 25, but after IPO, it kept on going down. It went to 20. So what that means is whenever it's below this price, when you say put, selling put means your options get assigned to you. That means you actually have to take delivery of that 100 stock at the price, which is $25. So when I took delivery at $25, what did I achieve? Basically, I said, even though the stock price was 30, I took a delivery after 1 month for $5 discount. So you're buying in future at a discount in case the price really goes down below that. So this is one of the things which always you have to think about. If you're worried that the stock may go down, this is also giving you the future price, which is the actually discounted price of the stock. So let's say you are making up your mind that I want to buy Apple or Facebook if it goes down to that price. If the option premium is already giving you that price by just selling that, then go ahead and do it. You can actually get that $25 price 1 month ahead of time, just because market is uncertain and they're giving you $5 premium for that option. So what I did after that, so then I had a stock for $25. Now I'm going to talk about selling calls. So once I had, okay, where is the other window? I think that window option chain disappears. That's the problem. Let me open that again. So let's say if this, of course, I'm not saying Asana is like Facebook, but what I'm saying is it's because the price is so similar and it just had IPO, so I would like to use the same thing. Now, if I use the same strategy here, that I want to buy it and I want to look at 1 month down the line, January 15, which is approximately a little over 1 month, 36 days. So $30 is giving you $3.60 premium right now. So you will be assigned this put. If it goes down, the stock goes down, you will be assigned 30 minus 3.6. So your cost will be $26.40. Now, at that time, when let's say the call price of the option will be most probably something like this, because right now the stock is 29 and $30 call is for the next month is $2.65. Now you can, when you get assigned, you own the stock. Now what you need to understand is when you own the stock, you can also sell call. That is like, just like we bought using puts, you can also sell using puts. What selling calls mean is if the price is above $30, the stock will be sold at 30. And but if it is below $30, this option will expire worthless and you will collect this $2.65. So that's the basics, I think, which I hope that everybody understands what's the meaning of options. So if the price is not in your favor, if you're not in the money, let's go back to this. At any point when you are not in the money, so $30 is the strike price. So above 30, you keep all the premium. As it goes down below 30, you are going to get this option assigned. But because you already collected $11, your loss starts. Sorry, I think we are looking at $5 here, not 11. So let me move back to 11. So in case of that 1 year option, you are still making money even if the stock goes down to $19. So that's the benefit of, so we were able to reduce the risk of price going down when you're investing in a stock at $30 price or $29 price, that 1 year from now, even if the stock price is lower than where you bought, you made money by this strategy versus losing money if you directly go and buy the stock. Is this point clear? Now, why is it not a win-win? Because while you are getting extra profits or getting a lower break-even point, your maximum profits are limited. Because you collected this premium above 30, if it goes to 60, that's why buying stock is still better if you think it's going to 60. But most of the time, you are more than happy to get 30% or 100% returns. By the way, if you're using margin, like TD Ameritrade allows me to buy this like this. When I sell options, I don't have to put the whole money. When you're buying the stock, 100 stock of Asana, you are going to pay $3,000 at $30. But when I'm selling options, I only have to give $1,000 in margin. And with that 1,000 margin, I'm able to make $1,100. So I'm making 100% returns. I don't care if it goes to 60 from here, because I still made 100% returns on the capital which I invested in. So this is a little more complicated math on how you define your portfolio returns. But basic intention here is to understand how do you sell puts and use this time premium, which is available in the market, to buy stock at a lower price. Is that understood?
Yep.
So I do have
Now-
I have one quick question. This is Beth. Do you hold on to it for that whole year, or can you sell it at any point after you've made whatever you want to make?
That's
What's
a great
the
question.
better
And
strategy?
yeah, this is what I wanted to talk about. This is exactly, I think, where I think this was till now I was covering what every book or whatever, like when you will read a lot of articles, which they do. What I do, let me tell you, what is really beneficial is you don't know how the stock will move. As the stock move above 30, this premium will keep coming down significantly, right? So because uncertainty of this stock being close to 30 is highest right now because you are in the actual stock price is 29 and you have sold a 30. Let's say the stock moved to 50. What do you think the 30 put premium would be? You can very clearly see that even 1 year from now, nobody thinks it will be less than 20 because it's already at 29 and the IPO was at 21. So people are not paying any premium to buy a 20 put. Nobody thinks it will go down below 20. Very few people think that. Sorry, this is 1 month. So, but anyway, let's say in 1 month, nobody thinks it will go down. So usually there are two reasons. Either this expiration time is coming down. That means the time is passing and you are well clear of the strike price. Or your stock has become too like $50 and there's a very low likelihood that this will happen. So your premium will start falling. As the premium is falling, you can always scare off. So you sold this at 11, you can buy back this put and exit this position at $5. Now what I do is I apply a 20-80 rule. If within 20% of the time remaining on this expiration, I have already made 80% of the money because the stock price moved favorably, I would exit that because now the remaining profits, for example, if my 80% profits are made, that means the premium has fallen from 11 to, let's say, 3 or 2.5. I've already made $800 out of, so by the way, when I say $800 or $1,100, remember that I hope everybody understands that options are 100 shares lot. You cannot do like one share or anything. Everything is $100. So when you say $11 premium, you are actually collecting $1,100 premium for every lot. So that is one point I just wanted to confirm. So there can be confusion if you're not familiar using options. So what I'm saying is when I collected 1,100, if I can buy back and square off this position much earlier at $300, why would I keep it? Because there is no risk. I have a limited upside. I can only make whatever is the premium left on this option. So just like $20 put is $4.70 right now, if the price is $50 in the market or $40 in the market, there is a high chance that this $11 will become $4.70. In that case, I would exit and say my annualized return, let's say if this happens next month, within a month, the stock moves to 40, I made my $6 or $7 on this. I would pay this $4 and exit this position because now my risk of holding it is much higher than the return I will get because my maximum return is whatever is the premium left on this option. Because I'm playing time. When I'm selling put, I'm only playing time. Because right now I'm getting $11 because I have a lot of time and I'm very close to this price. When I move to a $40 price, my premium goes down and still there is a lot of time. I should just book profits. So Beth, is that clear on the strategy wise? Now, I don't know if I'm going fast or slow. Means I feel I'm going very slow, but let me know. Means I definitely need feedback to make sure people are with me. So that is one strategy now. So once you enter this position, how do you exit? You're looking for time, like how much time is remaining versus how much more profits are remaining. So usually when like TD Ameritrade will show you if you entered at 11 and if the price of this option remain at $5.50, like that means it became half, it will show you that you have made 50% of the profits. Now, if 50% of profit are made very quickly and you still have a lot of time, that's a signal to you that the risk reward is not in your favor now, because if it goes up, And by the end of next year, because it's a long time, it comes back to the same price or even lower, you will not make any money. I mean, or in other words, you will make less money, and you can use your margin at a different in a different position.
So can I ask you to, what if you, instead of buying it at 30, you bought it at 40? I see the premium is quite a bit more, 1840. So obviously they're expecting the stock to go up, you know, basic, whatever, in a year.
Yes.
So how would that look if you bought it at 40 instead of 30? Like what would you sort of guesstimate?
Okay. So if you sell at 40, you are definitely collecting more premium, but remember 40 minus 18.4 is $21.60. While it is more bang for the buck, but the chances, like your break-even point now is in the adverse condition, when your stock moves adversely, your break-even will be $21.60 versus $19 here. That's the only downside. But I like this idea. If you're really positive on a stock, I always go for a higher put. Not close to the money, I go out of the money. And sorry, in the money. This is called in the money. For the put, it's in the money. So I actually sell in the money puts when I think that something has fallen too much or something has a lot of upside in the next 1 year. I would rather sell this because for the same, by the way, the margin is same. For the one lot, margin will be same and you will be collecting much more. So your actual return on investment is much higher when you are collecting more premium. And that's a great question. And this is exactly what you have to define. This is where I think you have to build your own strategies. It's about, you have to ultimately make a directional call and adjusting your break-even points. So if we go back to the option builder, okay, let me just move this a little bit here. So if you look at the strategy builder, if your stock price is 30 and you are talking about $18 premium for a strike of 40, now you see that your break-even point is much higher earlier, but on the other hand, your maximum profits have gone up now significantly. So yeah, I think this is these are a couple of ideas, and by doing this, you can always add on to these positions. Now, there's another thing. People ask me why you sell, like when will you sell 8 days to expiration versus 372 days to expiration? I think there's a very good strategy where so if you're collecting $11 on $30 in a year, you're probably making 33% returns. Most of the IRA and your they don't allow margin, so that is what you will have to pay. In case of a TD Ameritrade as a normal account, I don't have to put the whole $30 per stock for selling this put. I can put margin, which is around maybe $10 or $15. Then I'm almost making 100% returns in a year. There's another strategy where you can say, let me sell monthlies. So actually, it's not a great time because this is 8 days and this is 36 days. But in worst case, this will be mostly, let's say, after this date passes. Usually, you have 30 days difference between 31 days difference between two option expirations on monthly. What you can do is, you can right now only sell this, collect $2. But if you are able to, if the price is consistently here, you are able to sell $2 every month. Over 12 months, you are actually collecting $24 premium. So if you roll over, so this is the concept which then I will talk about rolling over. So what I mean by rolling over is, if you are selling $2 today, after 8 days, it remained above 30. So this was never executed and you never got stock assigned. You can, again, I'm sure if the stock price is around 30, this will look like, again, $2 by that time, or maybe a little more because right now it's only 8 days and this is 36 days. Depending on number of days, there will be some premium always. So options always have some time premium in future because there is always uncertainty over price in the next few days. So from that perspective, instead of getting a one-time premium of 11, you can also keep rolling over. But in this case, the risk is if the stock moves up within 1 month, the $30 put will become much, much cheaper. And then probably this premium will not stay. Then you will have to sell a $40 put. Then your break-even point is going up all the time. On the other hand, when you're doing the long-term put and you are very positive on the stock, you are more or less guaranteed if the stock moves up that you will have this kind of return. by next year. So again, all these there are a lot of variables here. So I don't want to confuse everybody too much, but there are ideas which we can use and which I heavily use is rolling over, which I say that some stocks which are much more kind of stable around a price. I use this strategy where I try to, or this for any day when we see a big down move on that stock, I just go and sell puts on that, and then I look for rolling over if I'm getting about to get assigned, because there's always a premium from one calendar month to another calendar month, and you can keep reducing your break-even point when you're rolling over the same put, even if you're in the money. As you can see, there's a 28 days difference between this December and January put, and there is almost $1.80 difference. So if you sell this, and if this difference remains by the time this 8 days happen, you always collect another $1.80. So within 36 days, you will end up collecting much more if you are still in the money and you don't want to get assigned on this stock and you don't want to own this stock. You just want to keep rolling over. So is that clear? I don't know. I mean, there are too many things here. Okay, so this is just one aspect I wanted to talk about where it says, okay, how do you sell puts? How do you, now the next question is, how do you generate yield? Like, let's use the same stock. Let me use Facebook now. Very interesting, because you will see much more. You will see actually weekly options. So the more volume stocks will have weekly options. They will have monthlies. So they have a lot more options to play around with. So what happened last couple of days, as you all know, that Facebook is getting some lawsuits and saying that, okay, we want to break it down, it's monopoly and so on. There's a lot of noise around Facebook right now, and Facebook stock yesterday, I think, moved down by significant amount, and today also it was low. Overall, what it translated into is there is a more volatility on Facebook. People are more concerned about it, and you will see the option premiums, put option premiums spike. So even though it's tomorrow's option, people are willing to pay like $1.15 out of the money put. That means they are counting on Facebook tomorrow to close below 274. So in a very, very basic manner, even when you're looking to buy a stock, you can easily buy Facebook stock for $2 and let's say 274.80. Yeah, you're talking about $2 lower than current price, or actually more than that, because the last price was 277.12. So you're talking about even tomorrow's expiry, you can buy the stock at $274 and rather than $277 by just selling put instead of buying it right away. So of course, again, the limitation here is that Facebook is a pretty high price stock. From option standards, you are almost committing to buying $27,000 worth of Facebook. That's always a downside in options. But I'm talking about, like, if you have that kind of appetite to buy, or definitely lower price stock, it's easier. Then you are almost always buying 100 stocks sometimes. But the idea here is that options are giving you a way to buy the stock at a discount to the market. Of course, and the reason it is the downside on that is, what if it recovers tomorrow and it never falls? Then you just collect this premium and you keep going. You keep trying, and maybe you sell the next week's option. And but you basically what you're saying is, I will only buy Facebook when it goes below 275. If you are not able to buy, you have nothing to lose, because you are actually collecting a $4 premium every week. What that means is, now think about it. If you are able to collect $4, if the Facebook stock never came down, you are able to collect $4 premium per stock every week. Multiply that $4 with 52 weeks. What does it become? You're actually buying Facebook stock for free next year in 52 weeks if you kept collecting $4. This is I'm just telling you how I built a huge portfolio of Facebook in early days of Facebook IPO, where my cost of Facebook was zero. It's very difficult for me. It was very difficult for people to believe it when I said I had a big chunk of Facebook after IPO for a cost of zero. Because every time you collect this premium, you put it in a bucket. You said, I now collected $4.80 on Facebook. And then if you combine all of it and that becomes your stock price, that means whatever now you're buying is for free. So this is the power of weekly options. And and in worst case, what will happen if you sell this put? You will get assigned. But anyway, you were planning to buy Facebook below 275. So you need to come up with a price below which you are willing to buy that stock and sell puts. This is a no-brainer. You should do that. Instead of buying the stock, you should always sell puts, especially for the volatile stocks, because Facebook right now, I'm not suggesting you that this $4.80 will always be available. So this is not, I'm not suggesting that next 52 weeks you can buy Facebook for free. But there will be days when the volatility will be higher. So that is another step of what I do is I look for opportunities when the volatility is higher in that particular stock. And sometimes I will right away sell December 18th as well as January 15th. Now think about it. I don't know whether in 1 month, if I do weekly options, whether I will get this or not. Of course, you need more money for it, and the margin helps because you're not paying the whole $27,000. When you're using margin for a bigger stock, usually for like S&P 500 stocks and stocks which have more kind of investments coming in, the margin requirements are lower from TD Ameritrade. So I would probably pay only 10% of the thing, so or 20% of the total money. So if I'm buying $27,000 worth of Facebook, I'm basically paying only $4,000 or $5,000. So I can do 2 lots. I can do one which is December 18th, and I can do January 15th, 275. What that means is I'm collecting this. If I get assigned this particular option, I will not buy this. Then I will keep rolling over. So there are multiple strategies you can use. You have to adjust your situation where you are. So let's say you're planning to buy 100 stock of Facebook. You got it assigned. Then you're saying, oh, this will also be a loss, by the way, by that time. But then you have to wait for January 15th, and then you have to figure out whether at that time you want to buy another lot or you roll over. Because even though you will get into losses on this option, you have $11 of cushion. Because by the time January happens, if we are back to 275, this $11 becomes worthless. So you are basically picking up $11 from the market just for this time. And of course, all of us know that the Facebook stock will not go to zero, even if the market falls. So you can keep rolling over if you have the capacity, if you are able to put the margin. So this is where I think the trick is. Some people who over leverage, they get washed out by the market because you did not plan for this direction. So what I always do is I never use more than 50% of my margin buying power in my portfolio. Just to make sure that because when you are buying on margin, you are leveraging your position. I'm only paying $5,000 to buy a $27,000 worth of stock. So in case this goes down, you should have the capability to support your position. What that means is you should be able to roll it over to next month and so on. And with that, what you're doing is you're basically playing the time premium. So you're at the same 275, you're collecting $11 every month. That means your cost or your break-even point keeps coming down by $11 because of the time premium. But the risk here is if it crashes to 230 or 220 or much lower, are you able to hold that much losses because your margin requirements keep going up? And that's where, as a portfolio, you cannot make too many mistakes. So the biggest thing in option trading is if you have a portfolio, bunch of portfolio, don't try to do maximum option buying power, which you had in the portfolio, you used it, and you're hoping for the best. This is the only mistake you should not do. As long as you know that 1 or 2 positions going south, you can support them with the rest of the portfolio, then I think it's pretty much doable strategy. And that's the risk management part of your portfolio, which I'm not talking about today. But if you're doing it with 10 or 20% of your purchasing power in the portfolio, it's a no-brainer. Everybody should use this strategy as long as you know that you are recovering this $11 every month by selling the same price put. And by the way, the fun part will be Tesla if you do. So the more volatile the stock is, it's easier to create the strategies. Now look at the Tesla weekly options. Wow, $46 So right now the price is 625. Even if you see out of the money, which is like you are currently for 8 days from now, you can buy the stock at $580. Even though the price is 625, you can actually buy it for 580. This is the discount market is giving you for selling options. Why should you go and buy at 625 at this month? With Tesla, you can recover this, like this is 8 days, by the way. I'm not even looking at monthly. Look at monthly. Now, what happens is monthly is giving you only $70 premium. You have to wait for it. Don't go for monthly directly. Look at, by the time you have 8 days on this option, this would have come down significantly. And this would have still be at 40 or 50. So if you roll this, these are the kind of stocks which you roll over every week. And within like 10 weeks or like 15 weeks, this doesn't even need 1 year. If the $40 premium remains, which I would not be surprised because Tesla is so volatile that most probably the premiums are always same. It never reduces by big amounts. You can actually get Tesla for free by rolling over all the time within 15 weeks. What the risks? Again, the risks are always there because first of all, you're committing to a huge $62,500 worth of stock. You need to have enough margin to support in case it goes down to 300, which is always a possibility. So those kind of, and the other option is, yes, if the stock ran away and became 1,000, you just got left with $40. You cannot make more than that while we are. So these are the variables you need to play around with. But assuming Tesla remains around 600 or 650, if you can keep selling the same put and keep collecting $40 every week or 8 days, and you are able to, within 15 weeks, you can get Tesla for free. So this is the, I think, just the power of options I just wanted to share. And like, sometimes it works, sometimes it doesn't. The skill here is how do you adjust to the market moves? And I don't even know how to share those things, but that is one example which I shared. Like if it goes down, one thing which I do, let me explain you what I do usually. Let's take this example of, let's go to Facebook because that I have done a lot of times, so I will be able to talk through exactly what I would do. So let's say today I saw, I don't like 1 day options, I like 8 day options. So let's say today I sell 275 at 480. And as I go closer to December 18, I'm actually going to get assigned because the price fell below 275. So I'm looking at the option and I'm saying, okay, looks like I will be assigned in a day. When this option is close to 1 day, most probably 275 will look like $1, just like it looks 1 day from expiration. It is $1.15. What I do at that point is I look at 1 week, next week, by the time we have 8 days left on this or 6 days left on this week, this will still be $4. So I roll over at the same 275 point and I get $3 in return. So I'm buying back at 115 and I'm selling at 480, let's say. You are getting $3.60 just for at the same strike price. So every week you are getting $3.60 or 70 cents when you roll over the option from 1 month to another. Is that clear? You have to do it very close to the expiration, and you need to look for whether you have the and the other option is, why not I move if the stock is going down? One more strategy can work in your favor is, don't like today, $1.15 I can buy back 275 put. On the other hand, I can sell 270 put on $3. Now this is bringing my break-even point even lower. Is this point clear? So this is a little more involved. If you move at the same strike price, of course you will get $3.70, but your break-even point is only coming down by 370. In case of moving 275 and rolling over to 270, you are actually being paid $2 and your break-even point is coming down by another $5. So because you're now on 270 put instead of 275 put. So you are in effect, by this rollover, you are getting $7 worth of improvement in your purchase price. Now, this is the most powerful strategy I have used on a weekly options to buy a stock which I want at a much, much lower price. So today I sold it, like maybe a few days back, I sold 275 put for $4, just like it is $4 8 days from expiration right now. Now I see that there's a big chance tomorrow it can be below 275 or close to 275. If I was holding this position few days from now, I would say, let me roll over. I would roll over to 270 put. So you have to always watch out this option chain. And your goal is to reduce your break even as much as possible. So as this, whatever put you hold, as it's going down in price, while you're not paying anything, because rolling over from 115 to 3, market is still paying you $1.85 or $1.90, while you are committing to buy now at a 270 instead of 275. And this will always be there. These opportunities are always there because of the time premium. And this is one way of, always never buying. And at some point you will give up and say, you know what, now it's a pretty sweet price. I'm not happy with $3 premium only, because what if it just keeps running up? Then I'm left with only $3 premium. I don't want to earn $3 on Facebook. I want to earn $100 on Facebook. So this is where the risk is. You cannot just assume that market will always remain in this region. Facebook can run up to $400. So while whatever I said sounds great, this strategy doesn't work because you only earned $2 or $3 per stock, and then this option became worthless. Of course, you did not lose anything, but you lost the opportunity which Facebook gave you to go up and buy. So then what you can do is, some people do a combo. What that means is, while you're selling in market for $4.80, you can also buy out of the money call. So basically what that means is, you are funding your call buy with a put sell, and that results into capturing the upside also. Now this can become complex if you're not familiar with this strategy, so I'm not going to expect that is something we should talk about, but I just wanted to share, like, selling put and rolling over, these are the strategies that work best for me. And the goal here is to just buy the stock at lower price. So that is, I think, what we want to achieve. And the next thing I would say is, I don't know how much time everybody has, and I think I have kept another 15 minutes for Q&A and maybe define next other things. One more thing which I do is generating yield on my stock. For example, if you have some very stable stock like Intel or many other things which you own in your portfolio which don't move like Facebook and stuff, but you want to own it, you should always look for selling calls against them, because those stocks usually don't move big, but sometimes because of volatility, you are able to collect premium against your holdings. What that means is, because many people tell me that they buy stock for dividends, for example. You can create your own dividend. If you hold 100 stock of Intel, you can sell a call which is out of the money. And if you annualize those yields, they look much, much better than dividend. For example, today Intel is $50. If you sell, let me see if I can say out of the money. So if you look at out of the money calls, January, so January 15, 1 month from now, you can sell a $55 call for 50 cents. That means you're getting 1% in a month, and then most probably it will not go above 55. And this, if that is the case, you are simply capturing 1% return, which means it is 12% annualized in a month by selling a very, very improbable event. And even if that happens, you are basically selling it at 10% higher than the current stock price. So you are basically saying, I'm willing to sell Intel right now if it goes 10% from here. But if it doesn't go 10% from here, you are capturing 1% on your portfolio in dividends. So people who tell me that they hold stocks like Intel for dividends or for like 3%, 4% yield, I don't see why you should not sell options and generate your own yield, because you're talking about 12% dividend yield here by selling out of the money call options. And also in process, you are just, the only downside is you're saying that, okay, you end up selling your stock for 10% up from here or 20, wherever you start doing this option selling. But most probably these stocks don't move that much. Like the dividend stocks, I've not seen they move that much. And there's always 10%, 12% yield to be collected for stocks which don't move much. And as you can see, market also is not giving it much higher chance of the stock going above 55 because the actual premium is very low. It's only 1%. On the other hand, something like Facebook or Tesla will always have much higher premiums because people expect the volatility, expect the stock to move higher. So that is, again, means building your own strategy in terms of risk reward, that's up to you. But basic idea here is options can be used to create your own yields, to buy stock at a lower price. And these are the things which I have used very actively on most of my portfolio. And like by selling puts or those kind of things, you can easily generate 1000% returns in a year like 2020. What happened in 2020 was like the V-shaped recovery, which we saw, the high volatility. Right now, when you're looking at these premiums, these are very low. Because again, let me show you what is the main thing is the VIX. So option premiums translate into VIX. And if you look at this, currently VIX is 22. But 6 months ago, I don't know if the chart is there, VIX was like in 40s. And at one point in March and April, VIX was at 80. And what that meant was the option premiums, which you are seeing today, which I'm telling you, like, you can get it for cheap. Like there were cases in April when I was selling like Disney stock or Facebook puts for for Apple put. I was able to get monthly puts for $30 on Apple, which was like, you are basically buying Apple stock at 30% discount if you are just willing to sell puts when this VIX was high. So this is one more thing you need to always look at. Like when do you enter into these options? If you're selling puts, you should look at spikes of VIX. Anytime when there is a spike of VIX, and you are waiting for, if you have some cash available to sell options against, or if your portfolio has a lot of stock and usually like you have buying power against that. Like when you hold stock in something like TD Ameritrade, they will give you margin capability on those stocks. You can use those existing stock to pick up and sell options on margin. Again, as I said, these are all the things which are very risky. So you need to understand the risk profile. You need to understand that you will not be called on margin. But what I try to do is I try to look for these opportunities of spikes in VIX. And as you can see, it happens from time to time. We got a VIX spike in September. We got a VIX spike in June, even though this was the best time. But because the panic was at the highest at that time, market was crashing. Nobody knew where the bottom is. But this is when I sold a lot of, for example, Apple. I knew that whatever market condition, if you have one stock in mind what you will buy, I would not buy it. In this condition, I was actually selling puts instead of buying the stock. So there was cases where I got Apple stock at 30% discount to already fallen price. And those options gave me return, like 80 to 90% returns within very, very few days, within like a month. And that was the time when the annualized yield on options was 1000%. Right now, VIX is kind of in early 20s. The option yields are still 70, 80%, or mostly 50%. I would say 50 to 100% range. As this VIX go high, selling time premium will be much higher to you whenever these spikes happen. So this is one thing to keep in mind. So, and this can be like, and again, VIX is an overall average market number. Remember that some stocks have higher VIX on any given day based on the news flow, based on what is happening in that stock. And I think, again, I don't have those tools right now in front of me, but and I don't want to confuse you, but there are a lot of, we call it Greeks, option Greeks, which is like theta, gamma, those kind of things. So you need to understand all those, which basically define a particular stock's volatility. So if you once get into options and become, familiar with how these things work, and there's a good thing to understand those Greeks, as we call them, which help you define what is the volatility of that particular stock. And based on that, you can make a decision whether this is the right time to sell puts. All right. So
Raman, can you hear me?
yes.
So you're saying during times of market volatility, when the VIX is going up, it's a good time to sell puts against stock you own. Did I understand
You want to
that
buy.
right?
Yes, the stocks you want to buy, if you sell puts at that time, you can probably go in the money rather than out of the money puts in that time, because what you're saying is probably the stock will go up and you collect as much premium as you can, so that if it goes up, you make all that money. The premium is in your pocket. On the other hand, if it keeps going down, you are buying at a much lower price than already fallen price. So you are, instead of, means, because that's the biggest worry everybody had, right? It's very easy to say right now that, oh, this was a great day to buy. March 16 perhaps was the best day to buy stock. But on that day, people were just worried that how far down this market will go. So it's easier for me to make a decision to sell puts, because that way I'm actually committing to buy at lower price than this day. Because I'm looking at the current price and I'm saying, okay, I will buy at $20 lower from here. And that's my break-even point, just like what we discussed earlier. Options allow you to reduce your break-even point way below your current stock price. So because that option is available for me to bring my break-even point much lower than this strike price, and if the price is already fallen and I'm uncertain that the market will not stop here, then why should I go and just pick up the stock? It's a no-brainer to sell options that day rather than just directly buying the stock. Because directly buying the stock, you have a linear risk. In this case, it's much more in your favor because of two reasons. One is the option premiums are high, so your break-even points are lower. And the second thing is, even if it keeps falling, you are coming to buy at much lower price as your strike price. So it's a win-win to sell puts when markets are crashing.
So if I didn't want to own the stock, then it'd be good to sell out of the money puts.
If you don't want to buy the stock, you can, yes, because out of the money puts also become higher when the market is crashing, because people are very uncertain and they think that the market will go down. And if you want to bring safe yields, but the problem with that approach is you only get that opportunity rarely, right? They're like once in many months. So how long, if you want to buy like a 3 months put, makes sense. You have to define how frequently you will get these opportunities. So if you're saying 2020 gave us like multiple spikes in VIX here, so if you assume that this is not the case for other years, like if you see, we got once in December 2018, the VIX was very, very low in big chunk of periods earlier. So these strategies will not work always. So these come rarely.
Connected to LAPTOPGCNUHU6 and Robert's iPad.
Okay, so I think this is where it's you need to define, like what I was talking about is earlier through this webinar was your usual strategies. Right now the VIX is 1820, which is not super high and not super low. But the strategies still work for me right now, but the returns become 10 times when the VIX spikes in these strategies. So you need to have enough cash at that time to leverage those at that situation. If you're fully committed with your portfolio, these things, these opportunities may not be useful for you, because you're basically, let's say if you are playing with these strategies around this period, you're already running losses. You're trying to cover your existing positions when this happens. How would you even benefit from this? Because most of the time is going into managing your margin positions, which are almost liquidating. So this is why stop losses and those things are very important. So in the hindsight, we can always say this was a great time, but if somebody was using my strategies on an active basis and overcommitting to options market, he did not have this opportunity, because he would be getting assigned all this way up, and maybe you were getting assigned here, and you missed this opportunity to sell here because you used all of your cash here itself. So I'm just trying to highlight that these things are not coming without risk. All of these strategies, you're basically leveraging your portfolio. So I don't think today we had time to talk about those, like how do you manage your risks. That is definitely something, whole big topic to discuss. But this was just an idea of what is possible. And in a normal market condition, you can build your strategies which are safer by trying to go with something which is, okay, I don't have that anymore window. Basically going with something which is out of the money and something which is, you have a strategy of how you will move things around. So let's say, let me go open this again. So when you enter any position like Facebook, you always need to look at what if the price goes down. What will you do? Like if you are at 277.5 today, and in 8 days, if the price is much lower, remember you can always do a simple math. Right now, 8 days from now, the price versus the option strike is $3 difference, but actually the put price is $7.25. So if you actually started with 275 and the stock is at 272 next week, most probably you will be losing money because even though the time has passed, your premium has gone up. So you need to have a strategy to define how will you cover it as you are making losses, because your margin requirements will keep going up. But as we explained, every week you are getting $3 or $4. By selling puts, you're basically, because the time of time expiration, you're always covering $3 of your losses, even if the position is going in reverse direction. So it's a matter of how long you can remain solvent, at what point Facebook stabilizes and start going up, and can you maintain your position all the way till then? And that's what defines your strategy, this weekly rollover strategy, to be successful. So this strategy will definitely not work if we have a big bear market where this went all the way down to 200 or 150 and you were not able to cover. But the good news in that is when the market is going down, your monthly or weekly premiums will also be going up. So instead of $3, by rolling over, you will be covering $5 or $6 every week. So it is still a much safer strategy. And while there can be hundreds of option strategies, I'm just in love with selling puts because it always works in your favor. Because of the time premium, because you are the one who is collecting the premium and you are always able to roll over. It's a matter of active management of your position, and do not over leverage where your portfolio is not able to support an adverse stock move. That's the only thing you need to worry about. Other than that, this strategy is one of the safest option strategies. Having said that, none of the leverage strategies come without risk. And I would say in my portfolio, I've used like 80% of my strategies are revolved around this, what I talked about, like selling puts, rolling them over. This has been such a beautiful strategy which has worked for me that I have been doing this for forever. And the cost of stock acquisition for me has come down significantly all the time for whichever stock I wanted to buy. So that's all we have. Thanks for joining, and looking forward to see you in more events. So if you want to join some of our webinars, we have been posting them on blockstartventures.com/events. You can go register anytime before the start of the webinars. Our next webinar is going to be focusing on macroeconomics and understanding what are the major challenges for investor in a post-COVID world, especially like as we can see, a lot of money is being printed, dollar is losing value, stocks are at all-time high. We saw at the start of the today's webinar the kind of survey results where people are concerned. 50% people believe that stocks can go down, while there are 100% of them are investing in it. So we will talk about all these things and what are the different challenges. So do join us, and looking forward to see many of you there. Again, you can go to our site, register for the next week webinar on investment challenges in post-COVID world. Thank you. So if there are no other questions, guys, thanks a lot for joining. I hope it was useful.
Yeah, thank you.